Why did Trump fire a U.S. Gov Statistician? Massive jobs data revisions exposed. Imagine a single data revision costing someone their job. That's exactly what happened to a U.S. government statistician, and it's a story that highlights the immense pressure and scrutiny surrounding economic data. But here's where it gets controversial. Was this a justified response to a significant error, or an overreaction to a common occurrence in the world of data analysis? Let's dive into the details. In August 2025, President Donald Trump fired Bureau of Labor Statistics, BLS, Commissioner Erika McEntarfer following substantial revisions to the U.S. payrolls data for May and June. These revisions weren't just minor adjustments, they were massive. The combined downward revision of 258,000 jobs for the 2 months was the largest outside of the COVID-19 pandemic era since at least 1979. To put it in perspective, this revision was so significant that it stood out even when compared to historical data spanning decades. And this is the part most people miss. Revisions to jobs data are routine. The BLS regularly updates its estimates as more survey responses come in and seasonal factors are adjusted. However, the scale of this particular revision raised eyebrows. For June alone, the initial estimate was revised downward by 133,000 jobs, the largest such revision since March 2021. May's payroll gains were also slashed by 125,000, marking the biggest second revision since 1983, excluding the pandemic period. Here's a closer look at how these revisions typically work. The monthly non-farm payrolls report, released on the first Friday of each month, includes an initial estimate of employment changes for the previous month, along with revisions for the 2 months prior. Over the years, these initial estimates have often been revised downward. In fact, 8 of the last 12. July jobs report, U.S. economy slowing down, why it matters. The July jobs report has sparked a heated debate, confirming fears that the U.S. economy is heading towards a significant slowdown. This revelation has sent shockwaves through the financial world, leaving many questioning the future of the nation's economic health. The numbers don't lie. Non-farm payrolls increased by a mere 73,000 in July, falling short of even the most conservative expectations. This figure, combined with substantial downward revisions to the May and June counts, paints a grim picture, with the 3-month average job gains dropping to a paltry 35,000, a far cry from the pace seen a year ago. Traditionally, job growth is a lagging indicator when it comes to recessions. However, the weakness in this area suggests that the economy may be slowing down even faster than traditional metrics indicate. Luke Tilley, chief economist at Wilmington Trust, sums up the situation. We are in a broad economic slowdown. The question now is whether it will lead to a recession. Wilmington Trust estimates a 50% chance of a recession, citing concerns over the long-term impact of tariffs on consumer spending, business investment, and hiring. Tilley highlights the impact of tariffs, suggesting that they have prevented inflation from rising as sharply as economists predicted. He explains, if consumers are bearing the brunt, they're spending more on imports and cutting back on recreational spending from airlines to theme parks and hotels. We've seen this reflected in the data, which is why there's no inflationary impact. Despite these concerns, there are reasons for optimism. The second quarter gross domestic product, GDP, increased at a 3% annualized pace, painting a picture of a vibrant economy. However, when considering the first half as a whole, GDP growth averaged only around 1.2%, with consumer spending barely inching up by 1%. The Q2 growth surge was largely due to a reversal in the import surge during the first quarter, as companies rushed to beat the tariffs. The July unemployment report is a cause for concern, suggesting that the economic outlook may darken further. Gus Fosher, chief economist at PNC, predicts weaker economic growth in the second half of 2025 and early 2026 compared to previous years, but no recession. However, he adds, given the revised labor market data, recession risks are elevated, and higher tariffs make that risk even higher. Goldman Sachs forecasts growth of just 1% in the final 2 quarters, attributing this to slower consumer spending and a sharp slowdown in real income growth driven by weaker job growth, higher tariff-related inflation, and reductions in transfer payments in the fourth quarter. White House officials remain optimistic, insisting that the economy is sound and will improve once Trump's One Big Beautiful Bill Act takes effect. However, Trump himself has pushed back against the July jobs report, firing Bureau of Labor Statistics Commissioner Erika McEntarfer and calling the numbers faked and rigged. White House economist Kevin Hassett acknowledges the concerning revisions, but also emphasizes broader economic strengths. He states, there are many good reasons to be optimistic about the second half of the year. But the jobs number, if the revision is true, suggests less momentum than we anticipated. The Fed is under pressure from Trump administration officials to cut its benchmark funds level, which influences multiple consumer interest rates. The Fed has held the rate steady, and several officials have publicly stated that they still view the labor market as strong. However, further signs of economic weakness could change this perception. Housing data has been poor, reflecting a decline in buyers and rising prices, along with stubbornly high mortgage rates. Jim Paulson, a veteran economist, writes, there is nothing healthy or solid about these numbers. They're way below the 2% stall speed and shout for help. Other economists agree, with Josh Bivens of the Economic Policy Institute stating, today's jobs report is what a recession looks like. Mark Zandi of Moody's Analytics adds, the economy is on the brink of recession. That's the clear takeaway from last week's economic data. Factory orders fell 4.8% on Monday, the worst reading since January 2024, and the Conference Board's Employment Trends Index declined in July, hitting its lowest level since October 2024. Despite these worrying signs, stocks have not fallen dramatically. Wall Street rallied on Monday, with hopes rising that the U.S. and European Union will reach a long-term tariff agreement. Trading has been volatile, with the Dow Jones Industrial Average off 1.7% over the past month. George Mateo, Chief Investment Officer at Key Private Bank, comments, this confirms our suspicions. We were waiting for the other shoe to drop, and now we're seeing a few shoes drop. He adds that investors have been complacent, ignoring political storms in Washington and adopting a best-case scenario outlook. Mateo concludes, a lot of people anticipated that the good times would continue, and they probably will. We still don't think a recession is the base case, but it will be a significant slowdown given the high uncertainty. The markets have been sending mixed signals regarding the Fed's next move. Traders initially assigned low odds to a rate cut at the central bank's September meeting, but then swung back to pricing in a nearly 90% probability on Monday. However, with multiple key data releases before then and tepid Fed rhetoric on easing, the situation remains uncertain. Mateo believes that the economic and policy uncertainty calls for caution. He advises clients to rebalance their risk exposures and move away from risky market sectors. The July jobs report has sparked a controversial debate, leaving many questioning the future of the U.S. economy. With economic indicators sending mixed signals, the path ahead remains uncertain. Will the economy recover, or will it continue to slow down? Only time will tell. IT job market in freefall. 26,500 jobs lost YTD. What's next? Crisis alert. The U.S. IT job market is worse off than anyone imagined this summer. The Bureau of Labor Statistics, BLS, recently admitted it overstated gains in May and June. So the July IT layoffs aren't just a minor hiccup. They're part of a far deeper slide. By the way, at first glance, the July payroll report looked almost flat across all sectors, with little reason for celebration. But here's where it gets controversial. The BLS quietly cut May's figures by a staggering 125,000 jobs and slashed June by 133,000. In reality, May added only 19,000 positions, not 144,000, and June gained just 14,000 instead of 147,000. An IT consulting firm, Janco, slammed these huge revisions as unacceptable. They blamed everything from shoddy data collection and crumbling infrastructure to outright political gerrymandering. Whatever the cause, the takeaway is undeniable. The tech sector is in worse shape than we thought. Victor Janulitis, Janco's CEO, put the numbers bluntly. Year to date, the IT workforce has shrunk by 26,500 roles. That figure includes downward tweaks of 4,300 jobs in May, 7,800 in June, plus 10,300 losses in July. To put it in perspective, this is 20,300 more lost jobs than at the same point in 2024, just as we enter the most brutal half of the year for tech layoffs. But the drama didn't end there. Within hours of the revised report dropping, President Trump fired BLS Commissioner Erika McEntarfer, accusing her agency of cooking the books to make his administration look feeble. Is this a justified crackdown or a politicized power play? And this is the part most people miss. Behind every data point, someone's career hangs in the balance. Uncertainty now looms large. Janco, long reliant on BLS figures for its monthly IT employment tracker, says it will seek alternative data sources to avoid another shock. Meanwhile, the BLS pegs the IT sector unemployment rate at 5.5% in July, well above the 4.2% national average. Yet CompTIA reports that the broader tech unemployment figure is a much healthier 2.9%. It's not all doom and gloom. Major cuts hit areas like custom software services, cloud infrastructure, and telecom. But roles for developers, software engineers, system architects, support specialists, and cybersecurity experts remain in demand. Janco notes that toughest to fill positions now center on AI, large language models, blockchain, and omni-commerce technologies. CompTIA's deep dive into AI hiring reveals an intriguing twist. Pure AI-only jobs haven't budged in 2 months, but postings that require AI skills in more traditional roles are on the rise. Their AI hiring index tracks demand for any position where employers expect candidates to wield AI tools effectively. Bottom line, in today's choppy economy and amid the AI gold rush, scoring a solid IT gig means more than technical chops. You need prompt engineering prowess and adaptability. But here's the burning question for you. Are these dramatic data revisions a sign of real economic distress or evidence of institutional incompetence? Or worse, political manipulation? Have your own IT career or hiring plans been affected by this roller coaster reporting? Share your perspective in the comments below, and let's unpack this together.